Hey traders, are you ready to impress your date or maybe just yourself with your Forex skills? Today, we're diving deep into the language of Forex and the different types of trading orders every beginner needs to master. By the end of this video, you'll feel confident enough to start demo trading and take your first step into the world of currency markets. So, grab a coffee and let's get started. Before you even think about placing a trade, you have to learn the lingo. It's like learning a new language, but way more profitable. First up, we have currency classifications. Major currencies are the big players. They're the most traded and have high liquidity. Think of the US dollar, the euro, the Japanese yen, and the British pound. Then you have minor currencies, which are less traded and come from smaller economies. Finally, there are exotic currencies. These are from developing countries, they're much more volatile, have higher transaction costs, and carry a higher risk. Beginners should definitely stick to the majors. Now let's talk currency pairs. In any pair, like USD, HF, the first one is the base currency, and the second is the quote currency. If you see USDCHF at 1.6350, it means $1 is worth 1.6350 Swiss francs. Your profit or loss is always calculated in the quote currency. Next, let's break down price movements. A pip is the smallest change in a currency's price. For most pairs, it's the fourth decimal place, so 0.0001. A pipette is just 1/10 of a pip, allowing for even more precise pricing. You'll see it as the fifth decimal place. When you trade, you'll always see two prices, the bid and the ask. The bid price is what you get when you sell the base currency. The ask price is what you pay to buy the base currency. The difference between these two is called the spread. Think of the spread as the transaction cost for your trade. The tighter the spread, the better. Finally, let's cover margin and leverage. Margin is the initial deposit you need to open a trade. It's not a fee, but a portion of your account balance set aside. Leverage is a powerful tool that lets you control a large position with a small amount of capital. For example, with 100-to-1 leverage, you can control a $100,000 position with just $1,000 of your own money. It can amplify your profits, but be warned, it can also amplify your losses, so use it wisely. Alright, now that you're sounding like a pro, let's talk about how you actually execute trades using different order types. There are two main categories, market orders and pending orders. A market order is the simplest. You're telling your broker to buy or sell immediately at the best available price. It's fast, but you don't have control over the exact price you get, which can slip a little in fast-moving markets. Next up are pending orders. These are instructions to trade only when certain conditions are met. A limit order lets you set a specific price to buy or sell at. For example, you can set a buy limit order below the current market price, hoping to get in on a dip. This guarantees your price, but it doesn't guarantee your order will be filled if the market never reaches that price. A stop order is the opposite. You set it to buy above the current price or sell below it. A sell stop, often called a stop loss, is a crucial tool for managing risk. It automatically closes your trade if the market moves against you by a certain amount, limiting your potential losses. A buy stop can be used to enter a trade when a price breaks through a key resistance level. Then we have the stop limit order, which combines features of both. It's a two-step order. Once your stop price is hit, it triggers a limit order to be placed at a specific price or better. This gives you more control over the fill price, but again, execution isn't guaranteed. One of my personal favorites is the trailing stop. This is a dynamic stop loss that moves along with your trade as it becomes more profitable. For example, if you set a 20-pip trailing stop on a long position, the stop price will automatically move up as the market price rises, locking in your profits. If the market reverses and drops by 20 pips, the order will close, protecting your gains. You can also specify how long your orders remain active. These are called time in force or TIF orders. GFD means good for the day, and your order will automatically cancel at the end of the trading day. GTC is good until canceled, meaning the order stays active until you manually close it. IOC and FOC mean immediate or cancel, and fill or kill, which are for traders who need their entire order filled instantly or not at all. GTD means good till date, where you can set a specific date and time for the order to expire. And for the advanced traders, there are conditional orders. An OCO order, or one cancels the other. lets you place 2 orders at once. If one gets executed, the other is automatically canceled. This is great for trading breakouts or ranges. An OTO order, or one triggers the other, means that when your first order is filled, it automatically triggers a second order, like setting a stop loss and a take profit target at the same time you enter a trade. Phew, that was a lot to cover. Now, before you even think about risking a single dollar of your hard-earned money, there's one critical step you must take: demo trading. A demo account lets you trade with virtual money in a real, live market environment. It's your trading simulator. This is where you practice your strategies without any financial risk. It's where you get comfortable with your broker's trading platform, learning how to place all those orders we just discussed. My advice? Don't touch real money until you can consistently generate profits in your demo account for at least a few months. Trading with real money introduces a whole new level of emotion, fear, and greed that you just don't feel with virtual funds. Demo trading helps you build the discipline and confidence you need to handle those emotions when the stakes are real. So I want you to make a promise to yourself. Raise your right hand and put it on your heart. Now, repeat after me. I will demo trade until I develop a solid, profitable system. Now take your index finger and put it on your head. Say this: I am a smart and patient Forex trader. You've got this. All right, let's wrap this up. We've covered a ton of ground today, from the basic lingo to the essential order types that will form the foundation of your trading career. For now, just focus on mastering the basics: market, limit, stop, and trailing stop orders. Get to know your broker's platform inside and out. And most importantly, practice on a demo account until you are consistently profitable. Patience is the key to success in this game. If this video helped you clear things up, do me a huge favor and smash that like button. It really helps the channel grow. Drop a comment below and let me know what your biggest struggle is with Forex right now. I read every single one. And of course, subscribe and hit that notification bell for more easy-to-follow Forex tutorials designed just for beginners. Thanks for watching, and I'll see you in the next video.